Hi, it's Mike Power with Silver Range. Well, I hope everybody had a great Christmas and New Year's break. And as we roll into 24, it's good to sit back and think about what might be in store in the year ahead. Here's our thoughts. First, quick word from our lawyers. It's safe to say 2023 was a bad year for us in precious metal exploration, and I think for a lot of our peers. It was tough to raise money, tough to get programs done, and option deals were scarce. As we go into the new year, we're seeing conflicting signals, and we're wondering what might be ahead. Here's a hopeful sign. VanEck GDXJ is an index composed of about 30 odd junior mining companies specializing in precious metal exploration and development. And in 2023, it bottomed out and turned around. We're looking here at integrated money flow. Think of it as money flowing into this index or flowing out. In about August, the index has turned and traders are starting to bid up the GDXJ, which I think is a good sign for the year ahead. However, that's just traders playing with existing stock in the market. The Orninc index is run by Kai Hoffman of SOAR Financial, and it's a measure of junior mining company interest in opening up new financings. When junior miners are opening up a lot of financings, the index is high, hopefully over that healthy 100 level. At other times, it's a lot lower. At the middle of December, the Orninc index hit a multi-year high, which is a very good sign, we hope, for the year ahead. But I should point out that the Orninc index in the past has made excursions above the healthy 100 line, only to quickly return to the dungeon, and there's been no real improvement in overall market conditions. Nonetheless, perhaps this is a sign of a better year ahead. But we need to face market reality. Mining exploration is a lot like the venture capital business, except we dress it up to make it exciting like a casino. But basically, we need inflows of money. Without that money, we can't do our job. No exploration, can't do deals, and we can't even run the companies. When money is tight in the business, it starts to constrict all of these things. Exploration programs are cut back as companies try and preserve cash. They cancel or postpone option deals and payments, and in some cases, they're forced to pare back their G&A, sometimes to the point where they have to get off the exchange and go down to NEX for a while. To really track the health of the mining exploration business, you've got to track exploration financing. And unfortunately, there's lots of very inaccurate proxies out there. Many of them are conjectural or anecdotal. There's very little hard data. But really, what matters is how much money is flowing into the treasuries of the exploration companies out there doing the work. It's the only metric that matters. We decided to take a look and see if we could get a handle on what's really going on. When companies run private placements or issue debt instruments in exchange for shares, they have to file reports with SEDAR. These are 45106F reports of exempt share transactions. They're your best measure of money flowing into the market, and they cover all reporting issuers in Canada, TSX, TSX Venture, and the CSE, as well as some private companies. So we had a look at the data on SEDAR going back to June to see if we could figure out what might be going on. Here's what we found. We've binned the data in 2-week increments, and on the whole, since June, financing seems to be slowly increasing with some notable spikes in September. The 6-week moving average smooths the data a bit and lets us see some longer-term trends in this data. An optimist could be excused for assuming that financings are actually looking pretty good and have been on the mend since June. But take a closer look. Here's the financings broken down by size. We've binned financings greater than $2 million in purple here. And you can see that most of the money being raised is for large financings greater than $2 million. Some of them are a lot greater than $2 million. For example, in September, there was a financing closed by Equinox for $200 million. And there's lots of big $20 to $80 million financings hidden in this data. So looking at the overall level of financing can be misleading because it's so heavily skewed by a small number of really large financings. Here's the number of financings closed by the size of the financing. Those large, greater than $2 million financings are shown in purple at the bottom, and our really small, less than 100K ones are shown in red at the top. It's very clear that those very large financings only account for about a fifth to a quarter of the total number of financings being raised, but they skew the data tremendously. To really understand what's going on in the junior mine financing game for the majority of companies, we have to look at what's going on in the smaller financings, less than $2 million. And that's because I think what we have going on here is a bit of a sampling paradox. Suppose you were a doctor tasked with keeping track of infectious disease outbreaks in a major city. Would you be better off hanging around the gym or the emergency room? Well, I think the same thing applies to looking at mine financings. Those financing stats, especially in aggregate, accentuate the winners. And they don't even cover the companies that didn't even bother financing because market conditions were so poor. So to get any indication of what's going on in mine finance, you have to look at the smaller financing. That's where the signals are. So let's look at financings less than $2 million. We stripped out those whales greater than $2 million. And what we're looking at here are financings that generally would allow a company to keep the lights on and run an exploration program. That would be a financing between, say, $200,000 and $2 million. You could run your G&A, do a small drill program, move the company ahead. If, on the other hand, you were in distress, you might be looking at a really small financing, less than 200 grand. Those are in the orange and red. You can see here that over time, there's been a healthy increase in the number of these financings, but that the amount of money being raised is starting to be skewed towards the less than $1 million financings, which is going to constrict how much work can be done and the health of the companies. If we zoom right into those small in distress financings, say less than $200,000, over time it's clear they're increasing both in number and unfortunately they're decreasing in size. There are more of the smaller, less than 100K financings than the 100 to 200K financings. This is a sign of acute distress in the market. The proportion of money being raised is also shifting towards those very small financings, once again indicating the companies are having a very hard time raising money down in this end of the market. Putting it all together, there are some hopeful signs for 2024. Traders are starting to bid up the price of junior mining stocks, and the companies seem to be a little more hopeful about opening financings, and many more of them seem to be heading towards the market, at least in the latter part of December. However, if we look at the money that's actually landing in the treasuries and the real health of the exploration financing market, the situation isn't good and the trend is still down going into the new year. Heading into 2024, Silver Range is short-term pessimistic and long-term optimistic. We believe at some point in the new year, there will be a real improvement in precious metal exploration interest and financings. We'll be ready for it. In the meantime, we're going to keep a very close eye on actual mine financing conditions, and we'll tailor our operational and financial plans to match them. We know there are better days ahead, and we hope you'll ride with us. Thanks.